The returns we made this year have come mostly on the short side. So at the start of the year, interest rates, long-dated bonds were around about 1.5%. That just looked far too low in a very complacent market, if you like, given that we had this inflation situation that the market thought was temporary, but at risk really of deteriorating. So in terms of trying to generate returns, positioning for rising interest rates in fixed income space has been helpful. And also, I would say equally, equity markets at the start of the year were priced for a pretty good outcome. PE multiples were high, especially in the US. And what we've seen is that rising pressure from interest rates has pushed equity valuations down. So actually this year has been a year really where if you have the flexibility to be able to have short positions, that has really been what it would have helped portfolios. It's very difficult, I think, to make much money on the long side this year. That being said, I think a lot of these moves now are potentially getting to the area where they might be quite extended. Bond markets now reflect, what you or I might have thought of as a normal kind of world pre-GFC. So interest rate expectations around 4% gives you a positive real rate across the curve now. So it's harder really to be betting on further rises in interest rates on a global basis beyond what the market is already anticipating. And similarly in equity space, valuations have adjusted lower in a lot of places. So European markets are trading on 9-10 times earnings. The US is higher at 15 times earnings. The danger there, I suppose, really is whether those earnings are going to be under severe pressure in the next 12 months as a result of all the challenges we've had this year around energy prices, supply chains, and primarily interest rates and the effect on consumer spending and the general level of demand.
And it's interesting how much currency headwinds seem to be taking a bite out of US companies' profits reports at the moment. Karen and I were discussing McDonald's and Nike earlier on, where you see a sizable increase now in the impact from that stronger dollar. How much is that going to affect your asset allocation decision through the final quarter of the year?
Well, we've been very cautious to pessimistically positioned on US equities for a little while, but yeah, I mean, that is a challenge. What is very interesting this year really is that equity markets are down a lot, 20-25%. And yet the earnings forecasts haven't adjusted lower at this point. That is quite an unusual situation. So the market is waiting for these earnings to fall. Now, of course, they could fall more than expected, but any sense that they don't, then you could get some sort of relief rally really in the equity market. But yeah, I think the earnings are absolutely critical at this point in time.
Can I ask you very quickly about how you think about FX? Because typically I think a lot of managers just hedge around it with certain assets they put in the portfolio. But at this point, we've got such extreme volatility. Are you having to be extremely careful around some of the trades?
Yeah, I think if you've got very elevated levels of volatility, then one probably wants to be dialing down the overall risk budget unless you think you're getting an absolutely stunning opportunity somewhere. And I think really sterling's captured all the attention the last week or so, but in actual fact, it's not moved that much beyond kind of normal-ish market conditions. I mean, obviously it's been volatile, but we're not too far away from where we were prior to the mini budget. Yes, sterling's been weak over the course of the year, as has the euro, but a lot of that really, I mean, most currencies are very weak this year against the dollar. So I think absent some outstanding opportunities, one needs to be quite cautious on that front, and indeed across all risk assets, really, because as we say, the volatility is very elevated.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.